Thanks. I'd like to thank the organisers for inviting me to this splendid conference, and I'll get straight on with my presentation. I'm going to talk about some of the short-term financial risks that Moldova faces. And I've often wondered how much an outsider can say that's of interest to people from another country who must know more about the country than we do. But I hope it's interesting to see what an outside perspective looks like. This first chart that I've put on isn't strictly to do with a short-term risk to Moldova, but it is a very current short-term financial risk. If you see its rates of lending to emerging markets from the end of May, and the rates of lending to Brazil and to Ukraine and to Russia all massively rise after Ben Bernanke's speech about that he might taper quantitative easing. So that's just an interesting sort of environmental thing of what's happening in the world economy and the sort of risks that exist out there. Oops, sorry. I'm going to start with my conclusions in case I run out of time. And what my conclusions are is that they're not too different from Mr. Mirzoyev's points, is that the banking system crisis in the European area has been an important and hot topic over the past few years, but to a great extent, Moldova's isolated from it. The bigger risk comes internally from Moldova, from the banking system. That's probably the biggest short-term threat, and it's a question seen from the outside of regulation and supervision. That's what would strike us with these stories in the press about, which I'll get onto later. The other one is the same as was said earlier, which is the external imbalance, which is a very large structural imbalance over many years, which isn't really to do with whether the currency is overvalued. It's to do with trade, and it's to do with remittances. So those are the things that I'll be focusing on. Oh, and the third one is, of course, the other one was pointed out, which is government debt is extremely low, which is, you might contrast it with, say, the Baltics, who built up an enormous debt before the crisis in 2008-9, and they're still paying it off. So in some sense, Moldova's weakness has helped it to shirk off quite a lot of burden that would hold back growth now. When we look at financial risk, it's often difficult to say what it is, but what it is basically is how credible is the commitment of the exchange of assets. So will the government pay its debt? Will the bank turn your deposits into money? Will the central bank turn local currency into foreign currency at the price that you think it's going to be? When this doesn't happen, when these aren't credible, people expect relative prices of assets to change, and that makes an incentive to switch between different kinds of assets, which is highly destabilizing for the economy. And it says, as the IMF representative said, that's the effect that destabilization can have on growth. It's not an end in itself, it's to make space for growth. So that's what people like me from the outside are looking at. Well, that is a financial crisis. That's what counts as a financial crisis. And that's what we're looking for. As you can see, I've put someone in a suit looking out for a financial crisis there with his telescope. But from the point of view of what we're looking at and what people from Moldova will be looking at, the sort of thing we ask is, will investors get their money back? That's essentially the question we're asking. But what you want to know is, how will this hit the economy? How will this hit economic growth? So there's slightly different angles on the same issues. This is how, at the Economist Intelligence Unit, we assess Moldova. We have, like other rating agencies, we have a scale. Moldova rates as a B. And just to say what that means, because later on I'll put in a few comparisons of similar countries that also rate as B, and I'll put in some comparisons with other emerging markets. B is somewhere in the middle, and what it formally means is, in our rating scheme, is that it can meet its financial obligations and wants to, but is vulnerable to economic shocks. That's the rating. And I put some comparisons in. That's the same as Moldova, Macedonia and Croatia. It's above Ukraine and a little bit below Russia. And I put the spectrum in to show the cool AAA rating, which when someone asks you, will you lend us some money, you would say, of course, help yourself. And at the bottom, the red hot area, D, which you would say, they ask you for your money, you say, are you crazy? Of course not, too dangerous. So Moldova's not too bad. That's for its overall assessment. But its overall assessment is based on three other criteria, or five other criteria, which I'm going to concentrate on three, which are bank risk, currency risk, and sovereign debt risk. I won't say too much about sovereign debt because I know Kilbinder's going to talk about it later. But I would say, from an outsider's perspective, the banking risk is the most important short-term one at the moment. To start off with, I've said some positive things because it's rude to come to a country and not say some positive things about a country. So I put some positive developments. As we said, non-performing loans have come down, but 12.6% of all loans is still high. These are bad loans. The two things I'm going to say about the banking sector are the non-performing loans and the rules for supervision. And the reason why a high level of bad loans is bad is because it weighs on bank profitability and it stops it being an attractive sector to move in. It could mean that extra capital provisions have to be made, and that ruins or hampers the bank's ability to perform its main role as a financial intermediary, taking money from people who've got excess money and lending it to people who want to put it into useful projects. So that's why it's such an important indicator of financial risk. And as I said, anything above 10% is bad. I put some other good ones in there. The bank assets have grown, Tier 1 capital resolution assessment, which is an indicator of ability to withstand unexpected shocks, is a good one, and then capital adequacy. But just to put it in perspective, I've put some caveats on that. Non-performing loans tend to rise in weak periods and after recessions, and another factor that's another weakness of the Moldova's banking system is, according to the IMF figures anyway, is net foreign banking assets are still negative. That impairs banks' ability to repay loans if there's a devaluation of the currency. So that's a negative one. And I've put in the graph, this is just to put Moldova in some context. Green one is Russia, falling, paying off its debts with massive amounts of oil money. Romania's red, so enormously high. And you can see Ukraine is coming down, and then the economic crisis at the end of, in 2012, massively pushed them up again, massively pushed non-performing loans up. So the second thing to say about banking sector rules, even more important for assessing financial risk in the banking sector is rules and regulations. It's by far the most important one. And as everyone knows, and everyone knows here who's Moldovan will know, the two cases of Macro-economist and Moldova Agro-Bank, whether, I don't know if you know the cases, I've just put some of the details of them. One's mainly to do with a very sharp fall in capital and a very sharp rise in non-performing loans. And the bad thing is the non-performing loans will weigh down the whole sector and make the whole sector look bad. That's one of the things. The other one is seemingly spontaneous foreign interest in investing in Moldovan banks all at the same period of time, which looks highly suspicious from the outside, whether it is or not. And as I was saying yesterday, that it's the perception. The perception is very important. No matter whether the rules are very well designed, very well enforced, stories like this create the perception that there are heightened risks. And the possible impacts of this for the sector are, the one for Macro-economist is it raises potentially, I'm running out of time, it potentially the increased strain on public finances because the government might have to put in money. The one at Moldova Agro-Bank highlights the possibility of to design and enforcement of bank rules, and both are big enough to affect the confidence of the sector, which again will undermine its lending role at a time when external conditions look grim. And the other one is, of course, banking crises are often triggers of currency and debt crisis. To me, it looks possible that it might not last because Russia's weakened and it doesn't look like the EU's going to pick up until the last year. Again, according to the information I had, remittances slowed at the end of the last quarter, investments unlikely to recover, and the National Bank has cut interest rates. So all these will tend to undermine the currency and could be in for faster depreciation, although I noticed since I've said that it's gone the other way. As happens. So basically on the risk picture, and I'll end on this, a managed flow, which Moldova runs, is considered better than a fixed peg because it's less risky and it leads to less distortions, less external imbalance. Moldova's also very good. Its foreign exchange reserves have improved a lot, which is a level of protection against fluctuations in the foreign market. And as you can see here, I've put in a comparison, foreign exchange to short-term debt is a standard measure of how protected it is. And for emerging markets, it's not as good as emerging markets in other countries that are rated as B, but it's still above 100%, and import cover is 4.5, which is considered very respectable. It's not at all bad. The worst thing, as we said before, is a persistent current account deficit, which isn't really to do with overvaluation of the currency. It's to do with over-reliance on expensive Russian energy, and it's to do with the reliance on remittances which don't have any productive or enough productive activities within the country to prevent them being spent on imports. And that ties in with the question of the banking sector, making the banking sector more useful, that people can put their money into it, they can have confidence in it, and that it can be a source for lending. As you can see, just to compare, this is, over the last 4 years, Moldova's current account deficit is averaged 8.5% of GDP, whereas for a B country, the countries in the same risk of category, it's 5.4%, and for most emerging markets, it's 1.6%. So you can see that that's a considerable risk, but it can only really be solved over the long term. Thank you.